It is episode 13 of the Medicare Navigators podcast. So glad that you're here today. Today, Elliot and I are joined by Elliot's father, Ray Martin, who is the founder of Martin and Associates Insurance Services. He is also the founder of Martin Wealth Management, also out of California. And today we're going to be talking about retirement. How can we make sure that we have a reliable source of income no matter how long we live during retirement, whether or not we need long-term care, whether or not our spouse dies? Today we're going to be talking about all of that and more with Ray. I'm so excited for you to join in the conversation.
Hi, this is Elliot Martin.
And I'm Becky Hatfield.
And we're coming to you from opposite ends of the country today to talk about Medicare.
We're asking
and answering all your questions related to Medicare so that way you can make an informed decision. This is the Medicare Navigators podcast.
Well, welcome everyone. I'm so glad that we're all together again today, and we have all been together in person, but sadly right now we find ourselves all over the place. So I'm over here in North Carolina. Elliot, you're at your home somewhere in Orange County office.
County. Yep.
Okay. And Ray, are you at home right now in Irvine?
Yes, I certainly am.
Awesome. Well, it's so neat that we can join each other today to talk about retirement and Medicare and how those things kind of marry together, because they do, and they're very important. And so we wanted to pick your brain, Ray, because you have kind of bridged those two worlds in your work throughout the years. You have worked a lot in the Medicare space.
Mm-hmm.
And Elliot, obviously, that's where you specialize in. You specialize in the Medicare space a lot. And Ray, you have shifted a little bit through the years, whereas now you have more focused on the retirement space and helping people to figure out how can they retire smart.
Yeah.
That's the whole game that you're focused on. So we wanted to talk today about how do we retire smart? How do we plan our Medicare choices so that we don't get shipwrecked with medical bills in our retirement? So to begin the conversation, Ray, how did you get into financial planning? How did you kind of make that transition from focusing more on Medicare to focusing more on retirement? How does your background with Medicare inform how you help seniors with planning their retirement?
Yeah, that's a good question. Well, I started out in the industry as an insurance agent with Prudential Insurance, and that was a very narrow field that was just focused on life insurance. And I was with Prudential for maybe about, I don't know, maybe about 3 years. But I began to see during that time that the people that I met with all had other issues that they needed help with and needed advice with. And so I actually left Prudential, went out and started my own company so that I could provide a more comprehensive, a more, I guess you'd say, a holistic approach to retirement planning. And one of those big issues that kept coming up, and I actually categorize it as 5 risks to retirement, but one of those is healthcare. And of course, once people reach age 65, they have to make a decision if they're still employed, whether to stay with their employer insurance, or if they're not employed, if they're not with their employer insurance, to go on to Medicare. And that becomes a very, very confusing world of Medicare, as our senior population today, well, I call them seniors, but 65 is really the new, I would say 45, because people who are turning 65, they're very smart, they're very computer savvy. And I wouldn't say, it's not the same as 65 back 30 years ago. But there's 5 major risks that I discovered, or I uncovered in retirement. One of those, of course, is the big healthcare risk. How much are they going to end up spending in retirement on healthcare and Medicare? The other risks are longevity risk. What if they live too long? What if they live longer than they expected? Also, there is the risk of market fluctuations. If they have a 401k or IRA, suddenly the market takes a nosedive, and they were depending on that money for income. The other risk is a taxation risk. How much taxes are they going to pay in retirement? Do they really know how much tax they owe? So those are just some of the risks that I began to see. And so that's what caused me to broaden my field and broaden my services to our clients.
That's great. That makes so much sense because you were kind of dealing with one of these risks
Mm-hmm.
in dealing with Medicare, but then you're also at the same time seeing all these people that are falling into these other pitfalls, and you're thinking, I need to help people see these other pitfalls, not just the healthcare pitfall,
Yeah.
but the longevity and the market fluctuation and the taxation. So, um, why, what, what was one of the more common mistakes that you were seeing people making when they were trying to plan their retirement?
Yeah, one of the biggest assumptions I think that retirees have is that they have a plan. And actually, in reality, most retirees really don't have a plan as to what's going to happen, where the money is going to go, where are they going to get guaranteed lifetime income. And that's really the crux, the most important question they need to ask is, well, okay, if I'm retired, I'm no longer getting a paycheck. So now where is my income coming from? And how much of that income is guaranteed lifetime, what we call guaranteed lifetime income, meaning it's income that will never stop. So that's very important. So one of the first areas of guaranteed lifetime income is our pensions. But pensions have disappeared. Whenever we do educational classes and we ask how many folks in here have a pension, let's say we have 30 guests at our educational seminar, and I ask, okay, a raise of hands, how many have a pension here? Usually only 3 people raise their hand. So
Wow.
that's really the percentage. About 10% of people today have a pension. The other source of lifetime guaranteed income is Social Security. And that becomes a very, very important issue. How and when people decide to claim their Social Security benefits can affect their life because what if they live 20, 30 years or more in retirement? That Social Security decision now becomes this huge decision that they have to make. And then there's other ways in our financial planning process. If that Social Security and pension is not enough, we have ways of then figuring out and creating lifetime guaranteed income.
Wow. You are just a wealth of knowledge. I wish we could have a whole day to talk about all these things. And I know
It's,
that you go into a lot greater depth with your clients that you work with.
well, it's
I
called
have
it's
this,
called 30 years of hard knocks.
yeah, I know.
Dad, tell us one thing that just kind of comes to mind is tell us like what is kind of a normal, if somebody who doesn't have a pension and they're just collecting Social Security, what are a lot of people doing to make up for that other income that they need to replace their, their living expenses? What are you seeing people doing? Are they taking money out of retirement accounts, or what's kind of the default that people do that aren't prepared?
Yeah. So what most people do is they retire, they roll over hopefully they have a good 401k or an IRA, or even better if they've had a Roth IRA,
Yeah.
and they roll that over. And then in retirement, here's the pitfall I found many, many times is people have no idea how much money they're spending in retirement. They think, well, oh yeah, our budget, yeah, we're spending about $5,000 a month. But what we do through our planning process is we actually go through what is called a spending plan with our clients. So they actually get down to the dollars and cents of how much they really are spending and how much they need, which is fine. That's fine if people have a budget and they have a certain amount they need to spend. But what we found is that when people really do this with us, it's a great exercise. They're shocked because they realize they're spending more money than they thought they were.
Mm,
So What they do, Elliot, well, obviously the first step is we've got to calculate what's the best time for them to draw Social Security. If they have a pension, is there a survivor benefit on the pension? And if not, or if they haven't drawn the pension yet, maybe they need to add a survivor benefit. Because what happens is when one spouse, obviously women live longer than men. So if someone, obviously, when one spouse passes away, not only do they lose one Social Security check, but the survivor ends up in a higher tax bracket because now they're in an individual single filer status instead of a joint filer status. So they get a double whammy. They lose one Social Security check and their taxes go up. So as far as generating guaranteed lifetime income, we use, obviously, insurance products are very good for that, but you don't put all your money in one basket. So it's very important that if they have an IRA, if they have individual large savings accounts of some kind that are sitting in the bank, there's a way of structuring those. We call it a bucket system, where they have one bucket where they have liquidity and they have emergency money and they get income into that. A second bucket is a bucket that generates guaranteed lifetime income. The third bucket is a bucket that keeps up with inflation. So that might be in some type of a very prudent stock market portfolio, but again, not stock picking or market timing or taking big risks, but a more prudently diversified portfolio. And what we found is that works very well because if the market does take a dip, they're not drawing income out of that bucket. They're drawing income out of, if you picture three buckets, there's one bucket that's liquid money, a second bucket that's guaranteed lifetime income, and a third bucket that's keeping up with inflation. So if the bucket that's keeping up with inflation, that's a market bucket. If that goes down a little bit, it doesn't matter. They sleep well at night because their income is coming from bucket number two. That was a little long-winded, but I hope that answered the question.
No, that's great because I think what a lot of people's plans are is just I'm going to rely on my 401k to make up for the money I need. And there's a huge risk there that people aren't taking into account. If the market takes a dip and then you're also pulling money from that 401k at the same time, I mean, that really erodes the longevity of your money, right? Big time.
That's right.
So you need to
And
have, that's why you
there's
have,
only one industry that can guarantee lifetime income and protection, and that is the insurance industry. Although, we love to hate the insurance companies, mostly the property and casualty, the
oh
auto
yeah,
insurance and the homeowners.
especially
They're
these days.
always increasing rates, but the life insurance industry is a very stable industry, and they can provide a lifetime guaranteed income and protect our principal as well. So we never lose our principal, but the money keeps growing, but we get guaranteed income out of that. So it's a very efficient system.
So when you talk about like insurance products as part of your retirement plan, are you talking about things like annuities?
Well, when you look at it, yes, the answer is
Okay.
yes. But here's where the confusion sets in because people are very confused about annuities because they always hear in the news or in the media, they're continually bombarded with annuities bad, annuities bad, annuities bad. But most of the time, people really don't understand them, how they work, or what kinds of annuities are out there. And there's actually 4 different kinds of annuities. The one annuity that gets bashed the most, and here's what people think when they hear the word annuity, they think, oh, that's got lots of fees and my money can go down and I can lose money, or it's locked up and I can never get at it. Well, that is one particular type of annuity called a variable annuity. And a variable annuity has sub accounts which can go up and can go down. And also variable annuities are loaded with fees. But people don't realize that there's 3 other types of annuities. There's what is called a SPIA, which is a single premium immediate annuity, which is very infrequently used these days. The second is called a MIGA, which is a multi-year guaranteed annuity. Think of it like a CD that's a CD that's on steroids. It does better than just a CD. It's usually about 1 to 1.5% higher than a CD. And if it's non-IRA money, non-retirement money that's in the MIGA, multi-year guaranteed annuity, that money, as it earns interest, is tax deferred. So actually, sometimes people use a MYGA instead of a CD because it reduces their taxes. And especially, I know Elliot talks a lot about IRMA, which are the tiers for Part B premiums. And the more income people have, the higher the Part B premium. Well, people don't realize it. Well, some do when they come and see us. But if they take some of that taxable interest, they set up a MYGA, which now shields those interest earnings from taxes. It lowers their modified adjusted gross income, and many times it can lower them into a lower bracket for Part B premium. And then the
And
third
that's,
type
yeah.
or the fourth type of annuity is called a fixed indexed annuity, and that's the most popular annuity in the market these days. And it can also it earns some of the market returns. It doesn't earn all of it, but it's indexed to the market. But also what it can do, Becky, is it can create guaranteed lifetime income that they can never run out of income no matter how long they live. So we take that longevity risk off the table with a lifetime guaranteed income.
Thank you so much for joining us for another episode of the Medicare Navigators podcast. We have a weekly Medicare 101 webinar that we would love to have you join us on. Go to our website at www.martinmedicare.com to reserve your spot today. Please join us again next week as we continue this conversation. All information related to this episode is listed below in the show notes.